All right, hello, and welcome back to the Broken Business Models podcast. We are your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer, nothing in this podcast should be taken as investment advice. James or I could have positions in any of the stocks we may mention in this podcast, and we reserve the right to change those positions at any time. So make sure you do your own work and always consult with a professional before making any investment decision. With that being said, the topic of today's podcast is going to be the EV company Rivian. So we've talked about Rivian at certain points in the past, but for those who may not be as caught up with Rivian as a business, there are several factors that we consider to be very big negatives for its business model and negatives as an investment prospect in general. And those are the extremely unfavorable unit economics as far as how much money they make or lose per car they sell, recent weakness in demand in the past couple of years for their cars, concerns about their upcoming new models, including the R2, and the R2 vehicles, and finally their balance sheet situation and financial losses, and the fact that they're quickly running out of runway. So first we'll talk about the profitability and unit economics of their business. So Rivian makes very high-end cars, the R1T and R1S EVs, which start at $70,000 or more, depending on the trim that you get. So these are very high-end premium cars, and by all accounts, very high quality. However, the problem is that the cost to Rivian to produce those cars is also extremely high. They just recently were able to reduce the cost significantly, but they still cost around $99,000 per car that they sell. So very, very difficult for them to make a gross profit. In the last quarter, in quarter four, which they just announced, they were actually able to make a small gross profit, but for reasons that James will get into later, that was mainly the result of an accounting technicality that James will explain. But overall, if you adjust for that technicality, they are not able to make even a gross profit on each car that they sell. As far as demand, after the EV mania of 2021 and 2022, where everyone kind of wanted EVs and they were in short supply, delivery volumes of Rivian's cars have actually been falling steadily over the past several quarters. So in the past, since 2023, there have been multiple periods where they've had consecutive quarters of declining deliveries, and their deliveries in the most recent quarter are still significantly below where they were a couple of years ago. And because of this, Rivian is betting on a couple of initiatives that they hope to rejuvenate demand, including their recently announced much cheaper R2 models, which they plan on releasing in 2026, as well as some cheaper trims and options on their R1 to hopefully spur demand. Getting into their financials, as you can see here in this bar chart, I've put down Rivian's total revenue in the blue bars, their gross profit in the orange bars, and their net losses in the red bars. And so as you can see, in 2021 and 2022, their revenue increased significantly, but by 2024, their revenue had plateaued significantly and was barely greater than their revenue in 2023. Looking at their gross profits have been severely negative for their entire history selling vehicles, and net income, when you take into account their R&D and their selling general administrative expenses, their total net income is severely negative, on the order of $5 billion in the most recent year. So they're burning billions of dollars per year. They're rapidly running out of cash, and they have significant debt against that cash. So their financial situation is quite desperate. Finally, getting into their plans for the future, as I mentioned earlier, their big bet for the future is their R2 model, which they plan to release in 2026, in which they plan to sell for on the order of only one half of the cost of their current, more than one half of the cost, but only $45,000 per unit, which is a significantly cheaper price point than their current R1 cars. So in order for their R2s to be significantly profitable and turn Rivian into a profitable company, they would have to massively reduce their production costs from the R1, which, as mentioned earlier, currently costs about $100,000 per car to produce. So they would have to bring that down by more than half in order for the R2 to be a positive gross profit model for them. So that's a summary of Rivian's recent history as a business. And so I'll hand it over to you, James, to talk about what happened in their most recent earnings report.
Yes, thank you. So in their most recent earnings report, we'll first analyze their vehicle production and deliveries, and then we'll look at the their financial statements, and specifically the surprising positive gross profit that they reported in the most recent quarter. So here we have in blue is the quarterly production of Rivian vehicles, and then the orange is the number of deliveries. Now, as Ryan explained, they have had problems with demand in recent years. So throughout 2022 and 2023, they were ramping up production. In the fourth quarter of 2023, production peaked at almost 18,000 vehicles. However, due to the high price points of the vehicles, they were having trouble selling all of their inventory. So if you notice here, the blue bars were consistently greater than the orange bars. That means that they were not able to sell all of the cars they produced due to a lack of demand. So as a result of the lack of demand, they drastically reduced their production in 2024. Also, in the second quarter of 2024, they conducted a retooling of their factory in Normal, Illinois, and the retooling was done to reduce, they changed some of the design aspects of their R1 cars and changed some of the manufacturing techniques in order to reduce production costs. So in Q2 of 2024, that's when the retooling of the factory happened. And then, in the latter half of the year, after the retooling was complete, the production increased a little bit, but it's still below the peak that they had at the end of 2023. And the reason why production has declined in 2024 is mostly due to a lack of demand for Rivian's cars. Therefore, they had to reduce production. Now, in the full year of 2024, Rivian delivered 51,579 vehicles to customers. They just provided guidance for 2025 that they expect to deliver between 46,000 and 51,000 vehicles for the full year of 2025. If we take the midpoints of that guidance, that's 47,500. So they expect to sell 47,500 vehicles in 2025. That is an 8% decline compared to what they sold in 2024. So the demand was already weak in 2024. That's why production declined versus 2023. Now Rivian is expecting that demand is going to get even weaker in 2025, resulting in a further decline in their number of deliveries. Now here we have, earlier Ryan showed Rivian's financial performance by the per year, the annual numbers. Here I have Rivian's financial results per quarter. And the reason we want to look at this on a quarterly basis is that so that we can analyze the most recent quarter. So here we have the revenue in blue, the gross profit in orange, and the operating profit in red. Historically, Rivian has incurred massive gross losses and massive operating losses. However, if we look at the most recent quarter, the fourth quarter of 2024, it does appear that there has been a massive improvement. Revenue increased to an all-time high, and their gross profit was actually positive for the first time in the company's history. This chart shows the revenue that Rivian makes for each vehicle that they sell, and then the orange line represents the cost of goods sold per vehicle for each vehicle that they sell. So the blue line, the revenue per vehicle, it was stable at approximately $80,000 per vehicle. Remember that the R1 cars, they start at about $70,000 to $75,000, but the price can increase significantly based on what trims and options that you get. So they were making approximately 80-ish, $85,000 per vehicle. However, in the fourth quarter of 2024, the revenue per vehicle skyrocketed to $107,000, which is the greatest revenue per vehicle that they have ever reported. At the same time, as a result of the retooling that they did in the second quarter of 2024, their cost of goods sold has decreased. And their cost of goods sold decreased to an all-time low of $99,000 per car in the fourth quarter of 2024. So the revenue increased to 107,000, the COGS decreased to 99,000, which left them with a small gross profit for each car that they sold. However, this gross profit can mostly be attributable to the sale of regulatory credits. And the way that this works is that in California, as well as some other states, the government mandates that all automobile manufacturers sell a certain percentage of their cars being either electric or plug-in hybrids. Now, there's a percentage requirement. So say, for example, that this year the requirement is that you have to sell, these are just, I'm just pulling out random numbers here just to show you the idea. But let's say that the requirement for EVs is 20% in California. So if you are an automaker in California, 20% of the cars you sell in California have to be electric vehicles. Now, if less than 20% of your cars are electric, then you have to pay financial penalties to the government. Now, in the case of Rivian, they only sell electric vehicles. So 100% of their sales are fully electric. So they are obviously well in excess of the requirement. Now, all of whatever EVs they sell in excess of the requirement, they have these excess regulatory credits, and they can sell those credits to the traditional automakers that are below the threshold, right? So that is, a huge source of revenue for Rivian because they have all these regulatory credits, which then they can sell to the traditional automakers, and they are basically getting a 100% profit margin on those sales because they're just, it's just like a piece of paper, like a regulatory credit that they're selling, and they're getting a lot of money for it. Now, in the fourth quarter of 2024, Rivian generated $299 million from the sale of regulatory credits. As we can see, the amount of revenue from the regulatory credits was much greater in the fourth quarter of 2024 compared to the previous quarters. The reason why there's so much in the fourth quarter is due to administrative reasons and the timing of things. Most of these regulatory credit sales happen at the end of the year. So the amount of revenue they got from regulatory credits in the fourth quarter was abnormally high. Now, throughout the entirety of the year, the Rivian generated $325 million from the sale of regulatory credits, of which $299 million came in the fourth quarter. So the vast majority, more than about 90% of the regulatory credit revenue is all concentrated in the fourth quarter. So here, this is kind of the same chart that we showed from a few slides ago, showing the revenue and cost of goods sold per vehicle sold. So basically the revenue and production cost of Rivian's vehicles. But here we exclude the impact of regulatory credit sales. And if we exclude regulatory credit sales, we can see that Rivian is actually still losing money. The only reason why they made a positive gross profit in the fourth quarter of 2024 is because that revenue from regulatory credit sales pushed up their average revenue per vehicle to much greater than the average selling price. Now here, let's dig a little deeper into the specifics of the numbers. So in the fourth quarter of 2024, their cost of goods sold for each vehicle was $99,000. The average selling price was $86,000. And if we take the normalized regulatory credit revenue, so what I calculated as the normalized regulatory credit revenue is I took all of the revenue that Rivian generates from the sale of regulatory credits in the entire year of 2024 and divide that by the total number of cars that they sold in 2024. And that gets you $6,000 per car. The reason I look at the entire year instead of just the fourth quarter is because, as I explained earlier, the fourth quarter has an abnormally great number of regulatory credit sales purely due to administrative and technical reasons. So to understand the kind of real economic reality of what's going on at Rivian, it makes more sense to spread out that regulatory revenue over the entire year across the entire year of production. So that's how I got the $6,000 normal value for the normalized value of regulatory credit sales per car. Now, if it costs them $99,000 to make it, if they sell the car for $86,000 and then they also get $6,000 of regulatory credits, then the total revenue for each vehicle is $92,000. However, this is still significantly less than their production cost of $99,000. So they are now they're really losing $7,000 per vehicle. And it's also very important to keep in mind that this is after they did their retooling. So the losses were actually much worse prior to the factory retooling, which happened in the second quarter of 2024. So to Rivian's credit, they were indeed able to achieve a significant reduction in their production cost and a significant reduction in their gross losses. However, they're still losing money. And given that the factory retooling has already been completed, there's no particular reason to believe that their production cost should decline anymore going forward, especially given the fact that demand is very weak to the point where they're even expecting that sales will decline by 8% next year. If sales decline by 8%, a lower production volume means lesser fixed cost absorption and a greater production cost per vehicle. Therefore, if anything, we should expect the losses to get worse throughout 2025 as the production volume decreases, as they have guided to. So the situation with the R1, Rivian's current cars, is not very good. As we explained earlier, the prices of the car are extremely high, leading to weak demand because not that many people can afford them. And despite the high price, Rivian is still losing money. Now, they're trying to become a mass market car maker with the release of their cheaper R2 car, which is expected to be released in 2026. It is expected that the starting price of the R2 will be $45,000. Now, the average selling price will be higher than that because it's starting at $45,000. There'll be different trims and different add-ons you can get that'll push up the price higher. So let's just assume, for the sake of argument, that the average selling price of the R2 will be approximately $50,000, which is a reasonable guess. Now, Rivian has claimed that the production cost of the R2 will be approximately one half the production cost of the R1. The R2 is slightly smaller than the R1, but Rivian claims that the design is much simpler, it has much fewer parts, and they claim that they're going to use new manufacturing techniques, which will be much simpler and much cheaper. So let's just take Rivian's word for it that the production cost of the R2 will be one half that of the R1. And it currently costs them about $100,000 to produce each R1. So that would mean it would cost them about $50,000 to produce each R2. Now, if it costs them about $50,000, but then their average selling price is also $50,000, they would break even. But then we also have to realize that we also have to consider the fact that they get the regulatory credits for each EV that they sell. And those regulatory credits, we calculated, are worth approximately $6,000 per car. So at least, based on this sort of back of the envelope math, they can maybe make about $6,000 of gross profit for each R2 that they sell. And the only reason they're making any profit at all is due to the regulatory credits. Now, if they can make $6,000 of gross profit for each R2 that they sell, how many would they have to sell to become profitable? Well, in 2024, Rivian had corporate overhead, so that's research and development and SG&A, that cost them $3.5 billion for the year of 2024. So assuming that their level of corporate overhead remains constant, they need to generate $3.5 billion of gross profit to break even on an operating level. So if they make $6,000 of gross profit for each R2, they would need to sell almost 600,000 R2s per year to generate $3.5 billion of gross profit. Now, 600,000 units would be huge. For comparison, in 2024, the single best-selling electric vehicle in the United States was the Tesla Model Y, which sold a little bit less than 400,000 units. For the Rivian to break even on a corporate level, they would need the R2 to be significantly more successful than the Tesla Model Y. And it's also important to note that currently Rivian is expanding its factory in Normal, Illinois. So their factory in Normal, Illinois is where they currently make the R1. They are currently in the process of expanding the Normal, Illinois factory to also have production lines for the R2. They say that after this expansion is complete, the Illinois factory will have the capacity to produce a little over 200,000 cars per year. But just to cover their corporate overhead, they need to be producing 600,000 cars. So the plant at Normal, Illinois is not going to be enough to cut it. If they want to if they really want to achieve such a high volume of production, they are going to also need to build a second factory, in which they are indeed planning to build a second factory in Georgia, although construction on that has not yet begun. And now let's look at Rivian's cash situation. So this here is Rivian's free cash flow. And in the past, they would have massive, massively negative free cash flow. They'd be burning more than $1 billion, in some cases more than $1.5 billion every quarter. In the fourth quarter of 2024, they actually made positive free cash flow for the first time ever, and actually a very significantly positive free cash flow of approximately $800 million. Now, the reason that they were able to make a positive the reason they were able to make positive free cash flow in the fourth quarter is because their production volume in the fourth quarter was very low, but they had a huge stockpile of many thousands of unsold cars in their parking lot that they were still in the process of selling. So in the fourth quarter, they sold approximately 1,500 more cars than they produced. And their level of inventory decreased by $430 million. So when you have a decrease of inventory, that benefits your free cash flow because you get an inflow of cash from selling your inventory, but you have not incurred the cost of replacing the inventory, if that makes sense. So they had $430 million reduction in inventory. Plus, they also received about approximately $300 million cash inflow from the sale of regulatory credits, which comes out of basically a 100% profit margin. So these are the only two reasons that they were able to have a positive free cash flow in the fourth quarter. However, they're actually, they still incurred an operating loss. This is kind of just a one-time thing of a reduction in inventory and the regulatory credits. The core business is still losing money. And in fact, for the full year of 2024, Rivian burned approximately $3 billion of negative free cash flow. Now, as we explained earlier, even after their factory retooling, they're still losing about $7,000 for each R1 they sell once you normalize the value of the regulatory credits. So they expect to sell 47,500 vehicles in 2025. If they lose $7,000 per vehicle, that'll be a total gross loss of approximately $300 million. In addition, Rivian incurs approximately $2.6 billion of cash operating expenses per year. This is excluding stock-based compensation, which is also very significant. But just the cash portion of their corporate overhead is $2.6 billion. If we add those two together, Rivian is likely to incur an operating cash outflow of approximately $2.9 billion in 2025. So the company is still on, at least on the based on the current trends, the company is still on track to burn a huge amount of cash this year. So as far as the cash balance, they have $500 billion of cash in equivalents, but they also have about $300 billion worth of bonds and other financial assets that they hold. So their total kind of financial liquidity is $8 billion. They are also on track to receive another $3 billion from the Volkswagen Group over the next 2 years based on the strategic investment deal that they signed. However, this $3 billion from Volkswagen is subject to certain operational and financial milestones, which Rivian may or may not be able to hit. Let's just give them the benefit of the doubt and say that they are able to get the entirety of this $3 billion from Volkswagen. That would bring their total cash balance up to $11 billion. The $8 billion they have now plus the $3 billion they'll get from Volkswagen. So that's $11 billion. But they also will consume a huge amount of cash over the coming years. As I explained earlier, they're currently in the process of expanding their factory in Normal, Illinois, in order to accommodate production of the R2. This will cost approximately $2 billion. If they want to build the Georgia factory, that's going to cost approximately $5 billion. So if they really want to achieve mass volume of the R2, they're going to have to spend $7 billion of capital expenditures. That's both the expansion of the Illinois plant plus the creation of the Georgia plant. Now, if we take that $11 million of liquidity that Rivian has, minus the $7 billion of CapEx requirements, that will bring their cash balance down to about $4 billion. As we explained earlier, we expect that Rivian will incur an operating cash outflow of almost $3 billion in 2025. So that'll wipe out, pretty much all of their cash. And we think it is highly likely within the next 2 to 3 years that Rivian will be forced to again tap the capital markets and raise even more capital in addition to all of the capital that they're already raising from Volkswagen. And obviously, these capital raises will either be in the form of debt or equity, which would be dilutive to existing shareholders. So the situation at Rivian is not looking good at all. They are, they do have a lot of cash, but their rate of burn is very extreme, and given the capex requirements, that cash is going to disappear pretty quickly, and they're still losing money on the R1, and it's very questionable whether or not they will be able to make a profit on the R2, which is significantly cheaper, and it's also questionable how much demand there's going to be for the R2 because given the fact that they're going to need to sell many hundreds of thousands of units just if they ever want to break even, which it's unclear if there's going to be sufficient demand for hundreds of thousands of R2s, especially given how poor the demand has been for the R1. So that about wraps it up with everything we had to say about Rivian today. As always, if you have any opinions or thoughts about Rivian, please let us know in the comment section below, and we will see you all on next week's video.